Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning and a very happy Sunday to you. You know what? I can't believe it. We're in August. Football's around the corner. Dare I say the Bears might be rejuvenated. In the same way, the stock market appears to be somewhat rejuvenated. Everybody thought the recession was coming in 23. Then they thought it was coming in 24. Everybody thought the recession was going to be here in 25, especially after they saw that horrible Q1 GDP print. But in case you missed it this week, no. Gross domestic product, it's alive and well in the United States. The narrative of hard landing versus soft landing, This is a soft landing story in America. And I think what we're going to do this morning is make sure you get what you need and what you want. That's sincere and actionable ideas that you can use to improve the lives of yourself and your loved ones financially. And part of that is if you're listening to AM radio like I am, it's because I'm a news junkie. I love information. I can't consume enough of it. And sometimes I want some help taking action. And that's where we come in. So one of the things I want to make sure you get is I want to absolutely make sure you know what's in OBA. David's in the studio with us again. David, what's OBA?
The Big Beautiful Bill.
Yeah, the One Big Beautiful Bill Act. That's where the A in OBA comes from. So I want you to go out to our website, getretiredstayretired.com. That's getretiredstayretired.com and download now for free our OBA, One Big Beautiful Bill. Tax opportunities for investors. And what's in there is chock full of just that, tax opportunities, things you can use to be better. Well, let's go ahead and talk about this narrative of the so-called hard landing versus soft landing. I think it's really important. I mean, we had the Fed decision. David and I are going to tell you what that Fed decision means for you and how you should be investing in just a moment. But when it comes to this hard landing versus this soft landing, I'm compelled to remind everybody on my scorecard the following. Jobless claims, they still look just fine. What I call non-defense capital spending, still fine. It's a soft landing. Retail sales, there's lots of people who still complain about how much things cost. But retail sales are just fine, $621 billion to be exact in America. You look at those non-farm payrolls, we got the information on Friday, but it's nothing that's going to get you scared. ISM, right? The Institute for Supply Manufacturing on the services side of the economy, we're at 50.8. Anything over 50 is expansionary, soft landing. The only thing that doesn't look so hot is manufacturing. And remember, we need manufacturing, ISM, to be over 50. Well, we're at 49. A month ago, we're at 48.5. So it ticked up. So we're not dead yet. And if these tariffs come through and we do onshore or nearshore stuff, that number's only going to get better. So, David, we think about this Federal Reserve meeting that just happened. And everyone's so critical of the Federal Reserve, critical over the fact that maybe we didn't get a rate cut in July. But I'm going to say this, even though it might not be very popular, I think the Fed decision not to cut rates was actually a little dovish, believe it or not. I'm going to talk about why that is. And I do think the market kind of declined without getting those Fed rate cuts a smidge. You saw that on Wednesday afternoon. You saw it on Thursday. But that decline, that softness, has nothing to do with the Fed. I think it has everything to do with the fact that there's a lot of good news already priced into stocks. In fact, there's so much good news priced into stocks that for stocks to move higher, we don't need good news. We actually need great news. We need great news. And I exemplify that by saying, the Fed reinforced for all of us that there is a current expectation of rates starting to go lower in September. Thank heavens, it won't be too late. It'll be just in time. But the market's just priced right. The market's not priced for perfection, David, but the market has so much goodness priced into it. Well, what does that mean for investors, and what should they be doing about it?
I mean, I think it gets back to, that old adage of buy the rumor, sell the news. We saw the first half of last week. We had 3 days in a row where the market declined a little bit in the face of like some really good earnings numbers for some big tech companies. So I think what's happened is the market had pushed aside all of the scary news from the tariffs and just said, you know what, eventually it's going to get worked out. That's already been priced in. So maybe if these deals do get across the goal line, don't expect the pop to happen. The pop already happened. So to your point, so the market price to perfection, that might not be accurate, but a lot of this news is already in the market. The smart money kind of already made their beds with this. And that's important for investors to realize. Once some of that data hits the headlines or hits the papers, it's usually too late already. We had joked about that earlier in the year, Craig. There were some articles in April that were preaching, Armageddon for the stock market. Once those articles show up on the front page of the paper, historically, that's really been a good buying opportunity, meaning it's already priced into the market. It's too late to sell out. You might as well step up and be a buyer.
No, that's right. So, hey, we're talking about where we currently sit in the economic environment. The soft landing remains intact. We're not having the worrisome technical recession. We just printed good GDP this week. Most things from retail sales to non-defense, capital expenditure to ISM on the services side to blah, blah, blah. All of it points to a soft landing. The Fed, even though I did want rate cuts in July, I think it's responsible to wait until the month of September for so many reasons. If we don't get a cut in September, there'll be massive disappointment. Don't worry. The Fed's not going to disappoint. I think it's going to come. But again, the market's not priced to perfection, but the market has so much good that's already priced into it. And that's why I want investors to be mindful of something. You need professionals, you need advisors who are going to go beneath the surface, because the danger for 2025 is complacency. Complacency. There's no room for complacency in this business. And I'm going to give you an example. Credit spreads are more elevated than people think. Not in a worrisome way, but credit spreads are more elevated than what people think. So, David, maybe we ought to talk about what a credit spread is, don't you think?
Yeah. The credit spread is the premium that an investor is getting above a treasury bond. So right now, in the bond market, I would argue investors are not being as compensated for taking additional credit risk. Meaning, if you're trying to buy higher yielding corporate bonds, you should demand a premium over a treasury bond. And today, things look pretty tight, which means there's really not a lot of reason why you would stretch for yield, because you're setting yourself up that if things go the other way, there might be more downside than upside in that investment return.
No, that's right. So, but credit spreads, while they haven't blown out, they are elevated from where they were 6 weeks ago. They're down from how difficult and how tough it got in the month of April, courtesy of Liberation Day that came and went. So to be clear, I just want people to know that the headline indices, which are dominated by large capitalization technology stocks, thank you, Mr. Microsoft, right? That's buoying the entire market. So I think people just need to be mindful that at these levels, whether it's credit spreads, whether it's price to earnings ratios, whatever it might be, these small gaps we're seeing They shouldn't make anyone second guess equity exposure at this time, but these small gaps should remind everybody that the S&P 500 at these levels leaves very, very little room for disappointment. And we need to keep that in mind and brace for what could be an air pocket, because all it takes is a headline, all it takes is a tweet, or an economic piece that indicates to slower growth to cause this market to give back a good portion of the retracement we've made since those April lows occurred. So, what's the bottom line? You want to get retired and stay retired? You need to work with people whose director of trading operations used to be on the floor of the New York Stock Exchange. We've got that person. You need to work with advisors that have a team-based approach. You deserve a family office experience. You deserve taxes, estate planning, retiree health care, long-term care, goals-based planning, cash flow modeling, and above all, your investment advice done under a fiduciary standard. We're a phone call away, 833-964-PLAN. Check out the website, GetRetiredStayRetired.com, GetRetiredStayRetired.com. The name says it all. When you're on our website, download for free our OBA, One Big Beautiful Bill Act. We've got a great guide that talks about the tax opportunities for all investors. So you're wondering how you qualify for that SALT cap. You want to know how you protect your enhanced senior deduction. You want to go back to the CARES Act for your above the line $2,000 on your joint tax return. You want to know how you can maximize everything that's in the One Big Beautiful Bill. Download our guide for free today. GetRetiredStayRetired.com. More to come. You're listening to Craig and David in the Know, VestGen Wealth Partners on AM 560, The Answer.
More in the Know Radio. You want more in the Know Radio? You can't handle more in the Know Radio. Okay, yeah, you can. And it's on AM 560, The Answer. Welcome back. Here's more with Craig.
There's so much stuff packed into the One Big Beautiful Bill Act, the OBA. And here's something that hasn't gotten a lot of play. Maybe it's because of the name. I don't know, but they're called Trump accounts. Yes, OBA has created Trump accounts. This is a part of the One Big Beautiful Act, and it's aimed at the simple concept of encouraging saving for a child's future by allowing parents or others to contribute up to a combined $5,000 a year for the child to use after attaining the age of 18. So how do you get to a $5,000 magic number? Well, maybe you're self-employed and you put in $2,500, and your company, since you're self-employed, puts in a matching $2,500. Then you get to $5,000. And best of all, again, the employer money that comes in does not count for gross income purposes. So a whole host of tax benefits. But maybe what caught the headline for so many is these Trump accounts. If your child is eligible and qualifies, that's all based on income, the government's going to seed it with an initial contribution of $1,000. So wait, if you have a child born in 25 through 2028, the government's going to seed your Trump account potentially with up to $1,000. Well, David, I don't know about you, but if someone's giving me $1,000 to put in my Trump account because I've got a newborn this year, next year, the year after, in 2028, I'm opening the account to get a free $1,000, aren't you, David?
100%. You thought a 529 plan was good because you got a state income tax deduction. This is way better.
Way better. But it also could be way worse. Now, what could make it way worse? What's the myriad of restrictions? It's the age bans. It's all this complicated stuff. But here's what I want you to know. If you want to learn more about Trump accounts, check us out. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. Download for free our OBA, One Big Beautiful Bill Act, where we address Trump accounts. Now, David, are Trump accounts available to open today in August?
Not that I'm aware of.
Nope, not yet. But all of that's coming. This stuff is going to be rolling out fast and furious this fall. And if you've got grandkids, you've got a nephew, you've got a niece, you've got newborn, someone who was born in 2025 before the year comes to a close, you deserve to know how you too can get your hands on a Trump account. But before everything is finalized and before things are printed and before things can be implemented, I think it's a great time to remind everybody the do's and the don'ts when it comes to saving for opportunity that is born out of education. David, should we be using an education IRA, or should we be using a 529 plan, or should we be saving in the name of the child? Which one? Why not? And how come?
That's a tough one. There's a lot of reasons. So generally speaking, for those that live in states where they provide state income tax benefits, we're going to want to opt for that 529 plan. In Illinois, if you pay state of Illinois income taxes, you get to deduct up to $20,000 of contributions if you file a joint tax return. That money grows tax deferred, and assuming it comes out for higher education, you get tax-free distributions. Now, there are educational savings IRAs, which were kind of what I view as the original 529 plans. And lots of people like to make gifts to minor children, and then that money is held in the child's name. However, in real life, if we're applying for student aid, typically we don't want to have a lot of assets in the child's name. So I think the beauty of the 529 plan is if you're a parent or a grandparent looking to create a jump start for that child's education, you open the account, you maintain ownership of that account, which also means it is not an irrevocable gift to that child. It is still your money. And if you want to in the future move that money to another child's name, or you have additional grandchildren in the future, you're free to go ahead and split the money in between multiple accounts. And you can do it with some form of anonymity, because then you don't have to tell anybody how much you put into this grandchild's account versus that grandchild's account. So I think my answer, Craig, is in a lot of cases, the 529 plan wins. And with legislation that was put in a couple of years ago, the kids decide not to go to school, they also have the opportunity to roll some of that money into a Roth IRA. I don't know about you, but if we're not going to school, being able to jumpstart a Roth IRA for retirement is a great opportunity.
I think it's huge. So listen, everybody knows that part of the American financial planning crisis is and has been solving for the high cost of education. We all know why the cost of education has ballooned, and we're not going to get into that. But the bottom line is, if you've got people that you love and they love you back and you believe in education, by far, the best way for you to probably save towards that goal is through a 529 college savings plan. And I encourage you to really take a look at working with advisors who are going to represent your fiduciary standard to make sure you get the tax benefits, or in some states, tax credits that you deserve, by setting it up right and investing on a glide path that's a pathway to success, is a pathway that says yes, because these plans can't just be set it and forget it. They need to be managed, especially when it comes to distribution. And David mentioned it. It doesn't get enough airtime, so we're saying it here. People used to worry, oh, I don't want to be overfunded for college. I got news, David. It's pretty tough to be overfunded for college, isn't it? Sure is. But people don't necessarily go to college anymore. Everybody knows you're going to be charging $500 an hour to lay a wax ring for a toilet in the future. Everybody knows you're going to be charging $500 an hour to do basic projects, because no one's got human skills anymore. People don't even have a toolbox, right? If you can't Amazon it, no one can figure out how to do it. So that's why we are a big fan of, right, Mike Rowe, all of the trades, but those unused balances in 529 plans, they can and will get converted into a Roth IRA. So if you've got an old 529 out there and you're wondering what to do with it, whether it's take it back, pay the taxes and buy a boat, whether it's to give it to the beneficiary, or you want some help converting it to a tax-free safety zone that can empower the next generation, give us a call, 833-964-PLAN, 833-964-PLAN. Go out to our website, getretiredstayretired.com. Now, David, something else that I think is really important. We talked in our first segment about the soft landing being intact. We talked about GDP being okay. We talked about, what we learned this week in terms of jobs numbers. I hinted at it, especially with the data that came out on Friday. But all of this is related to something. It's inflation, the velocity of money, which is money supply, and ultimately interest rates. We got no love from Jerome Powell in July, but it is going to come in September. I think we're going to get a follow-on act in the December meeting. So that's at least 2 cuts, which means it's last call, everybody. It's last call. David, when we say it's last call for interest rates, what does that mean to you as an advisor, and what are you doing to help people be successful before rates go lower?
For a lot of our clients, when we set up income plans, we are laddering things like CDs or corporate bonds. And I think what you're referring to, Craig, is if they cut rates, we don't want to miss out on what's available today. So any folks that have maturing CDs, I'm trying to encourage them to push them out farther before rates drop. That's like that renewal risk. And more specifically for 401k investments and IRAs, we are trying to lock in yields today so that as families retire, they know exactly where their income is going to come from, and they can lock in a competitive return, not just for the next 6 months, but perhaps the next 4, 5, or 6 years. Those first several years of retirement are the most crucial. And I want to lock in the yields now, because if I have to buy them in 2 years, I'm going to be locking in something that starts with a 3, not a 4 or a 5.
Absolutely. And David, I think when we come back, we need to tell people about some other things that they should be doing with those rates, because there's too many people, as you alluded to, hanging out in high yield savings. I love high yield savings. I love institutional money markets. Our rates at VestGen are next to the best, but those rates are all going to come down. David, people have CDs that are going to be renewing. There's opportunities for them. And David, there's an entire swath of Americans who have various forms of annuities that are terrible. Not all annuities are terrible, but if you have an old annuity and those annuities were purchased during that decade-long period of time that David calls ZIRP, zero interest rate period. If you bought your annuities when interest rates were at or near zero, David, are those things making any money?
Not so much.
Not so much. So it's time for an annuity upgrade. And I'm going to show you how to do that when we come back after the break. All right, our number, I think you know it by now, 833-964-PLAN. That's 833-964-PLAN. You know where to go. You want to go to getretiredstayretired.com, getretiredstayretired.com. Today, I'm directing you to download our OBA guide, One Big Beautiful Bill Act. It's chock full of the opportunities that you need as an investor to take advantage of this enhancement to the tax law. More coming up. Craig and David in the know. VestGen Wealth Partners, AM 560.
Like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
We usually don't spend a lot of time talking about very specific product types, but I'm going to mention something. I think with interest rates set to come down later this year. Oh, and if you don't think they're going to come down, then you're not paying attention to the news. Rates should be dropping. I still think we're in for at least 2 rate cuts between now and the end of the year. That being said, if you've got old annuities, these are the annuities you bought back when savings accounts didn't pay that much, back when auto financing was cheap, back when mortgages were cheap, and you find yourself scratching your head, whether it's a MIGA, whether it's a fixed indexed annuity, it's not making money because your annuity is tied to interest rates that were in effect at the time you made the purchase. And if that's you, you need to take a look at what's out there today. So we're going to do education, not recommendation. Again, this is education, not recommendation. But David, if I had money that I wanted to invest and keep it safe for 3 years, I could do a 3-year multi-year guaranteed annuity. And the rates today for a 3-year multi-year guaranteed annuity are approximately how much?
Probably just shy of 5%.
Right around 5-ish%, right? You can get rates anywhere in that 4.9 to 5.25 range today on 3-year MYGAs. In the same vein, David, what is a MYGA? Again, as a reminder.
A multi-year guarantee annuity. So it's a set interest rate. You decide the terms, 3 years, 5 years, 7 years. You get tax deferral. Typically, most contracts give you 10% free withdrawals throughout the year. So it's a very safe investment, depending on the credit quality of that insurance company, but it creates what I call a known outcome. So you know exactly what you're going to earn. Not a lot of bells and whistles, Craig, and quite frankly, I think that's why no one talks about them, because there isn't anything fancy. As it's as vanilla as it gets, but I think for retirement, sometimes simple is very elegant and effective.
Absolutely. And if you didn't want to get something in that 4.9 to 5.25 range, you could maybe go out 5 years. And if you're looking at a 5-year MYGA, you're going to see rates in the plus or minus 5.5%. That's 5.5% each year for 5 years. Couldn't be much simpler than that. Well, that's one safe money idea for those who have old annuities that aren't making much money. Take a look, maybe lock into a new 3-year or 5-year MYGA to lock in plus or minus 5 to 5.5% rates. In the same vein, David, there are people who have fixed indexed annuities. Those are the type of annuities that participate in the market up to a cap without ever experiencing any decline. And the key is, David, what influences or controls those cap rates is not stock indices. It's all about interest rates, right, David? And we've seen people from this radio program come to us and be like, boy, I have a fixed index annuity that never earns more than 2 to 3% per year. It's probably because, and it is because they bought it when interest rates were low. But David, people can get caps on fixed index annuities, which are how high today when they're tying their money up for 5 to 7 years?
Oh, the caps today are probably closer to 9 or 10%.
Caps are closer to 9 or 10%. So if you're willing to have 9 to 10% upside in an index on an annual point to point without any downside, there's another opportunity for you. So the bottom line is you have old annuities out there. It's time for an annuity upgrade before interest rates go low. In addition, there are people out there who can and should be taking advantage of the PPA. David, that's the Pension Protection Act. So maybe you have an old annuity. Maybe you have no intention of cashing in your annuity because you don't want to pay the income taxes. But what you've been hearing about is this avalanche issue, the second avalanche issue of the day in American financial planning. It is not the cost of college. It is long-term care. And David, the Pension Protection Act allows you to take an annuity and turn it into an annuity with long-term care benefits that can then be paid to you tax-free, right, David? Mm-hmm. Anytime something is tax-free, I get interested. So maybe I put $100,000 into some annuity a decade ago, 20 years ago, 30 years ago. Now that $100,000 annuity has grown to $200,000. If I cash it in, I got to pay $100,000 worth of ordinary income taxes on the gains. I don't want to do that. So maybe what you do is if you believe that you or a person you love might need long-term care in the future, maybe you should consider upgrading that old annuity to a annuity that's congruent with the Pension Protection Act, so that $200,000 balance can give you 3 times leverage or $600,000 of long-term care benefits that could be used tax-free. If you want to learn more, you can. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com, and learn how to go ahead and utilize an older annuity that isn't doing you any good into a long-term care solution. Download our free guide, a short intro to long-term care, where I reference the Pension Protection Act and what it does. So, David, I think we got most of this stuff out of the way. We went ahead and talked about interest rates coming down, but in September and December, we talked that it's last call. Anyone who has old annuity contracts that were bought during the days of low rates, you got between now and the end of the year to look to do annuity upgrades. David, we also have to think about bonds. We totally got to think about bonds. David, right now, I think the greatest story not being told is tax-free income. Because when I take a look underneath the hood of the municipal bond index, David, the municipal bond index by far is paying yields close to 4%. Tax-free. That's 4% tax-free yields. My heavens, a 4% tax-free yield, depending on your tax bracket, that could easily be tax equivalent to 5.5, 6, depending on what things might be. David, why are muni bonds on sale today? And what is going to be the catalyst to drive prices higher in the future?
Well, we had a lot of liquidations in the muni market in the spring, probably because people had tax bills, right? Individuals are the largest holder of tax-free bonds, and when there's bills due in April, sometimes you liquidate what's safe. We also had massive issuance, so a lot of new bonds issued, and a scare that the government might take away that tax-free nature of the bond, which was a scare for a couple of weeks, but that's now passed us by.
Which helped drive all the issuance of new bonds prior to bonds that were municipal losing their tax-free status. So anytime you increase the supply of something, the value of that something becomes worth less, right? We all get that. But David, these forces are going to work themselves out. So why should people be looking at tax-free munis today?
Well, you already pointed out, if you're buying a muni bond with a 4% yield, the tax equivalent yield is, depending on your tax bracket, much higher than 5%. And if you think of what your options are today, I mean, we all know that there was online banks a year ago paying 5%. Most of those banks today are paying 3.7%. And remember, if you have a CD or you have an online savings account, do you really get to collect all 3.75%? No, of course not, right? A portion of that's going directly to the IRS. And a lot of people the last year have recognized that when they do their taxes. I mean, it's awesome that CDs and banks pay real interest. And then a lot of people find out that they didn't pay enough in taxes. And it's because all of a sudden they have, interest income on their tax returns now. So if you can buy some tax-free bonds, hedge your bets for the future. I think the key is if you buy the individual bond and you hold it, you are creating some more known outcomes. And we'll just hammer this home one more time. Craig, you mentioned the market is being priced close to perfection. Why not take some profits in the stock market for a portion, lock in some tax-free bonds, and call it a day? It's these small moves that drive long-term performance and peace of mind. And I think we do a really good job at VestGen Wealth Partners creating those plans for folks. So let's say go to our website, getretiredstayretired.com. We'll finish more of this after the break.
It's more In the Know Radio with Craig Balanas on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
So it's so important that we always focus on our ADRs. I'm not talking American Depository Receipts for all you home gamers out there. I'm talking about your allocation your diversification, your rebalancing protocol, and your security selection. And I just want to give a quick public service announcement to everybody. I feel like I'm a broken record, but it deserves to be repeated once more on a Sunday. Everybody regrets that through which they didn't do more so than the things that they did. Let me say that again. Everyone regrets what they did not do more so than the things that they did. And you can apply that to life. You can also apply that to investing. I apply that to investing in this way today. There's all these different stock indices out there, the NASDAQ, the S&P, or the good old-fashioned Dow Jones Industrial Average. And when I think about something as simple and eloquent as the Dow Jones Industrial Average, didn't the Dow Jones Industrial Average make, it's one proxy for the stock market, some 16% in 23? Didn't it make again some 14% in 24? Isn't it up strong single digits today? What's wrong with you rebalancing some of your paper profits, turning them into real profits, to purchase things that create permanence and definition in your portfolio, like David talked about in that last segment? What's wrong with just taking some of your gains off of the table? I didn't say get out of stocks. That's insane. Owning a slice of America is one of the best ways to grow and build your wealth, but it's all on paper. That's why you have to have a disciplined, regimented process to rebalance. And you should never have to apologize to anybody to take money from stocks, to drop some dollars into 4% tax-free munis, 5 to 5.5% guaranteed MYGAs, or some other vehicle that's designed to help you stay wealthy. David, talk about how you go about addressing clients at VestGen to create these cash flow reserve accounts, and how you're today helping clients do just this: harness some paper profits in a market that's not priced to perfection, but it's a market that has a lot of good already priced into it.
One of the things I always talk about with folks is you never deal in absolutes with investing. And I think, when I do reading in the evenings, or I listen to stuff at night, everything is so sensationalized. And I think there's a lot of people, Craig, in our industry that do deal in absolutes. When the market goes down, all they do is tell you to buy an annuity. Or when this happens, you have to put all of your money in gold. Or when the market goes up, you got to put all of your money in tech. And I think the reality is you can't do that. Anybody that is centered in their finances know that those are all tools that you can use to accumulate and grow wealth over time. And I think at this juncture in the market, coming off 2 good years in 2023 and 2024, I think part of the price you pay to retire is you can't just have everything high octane in risk assets, but that doesn't mean you have to have everything in safe stuff either. So to your point, I think the way we make these decisions is we got to think about how much money we're going to need. So when I'm sitting down with couples and we're trying to plot this out, we're essentially just reverse engineering how much money are we going to need from the portfolio on top of their other sources like Social Security. And then we're going to back into how many years of safe capital do we want to put on the sidelines. And I think the key is it's an ongoing process. So, before they retire, this is the key, before they retire, like a couple of years before they retire, we set aside some capital, maybe 2, 3, 4 years of safe money. And then as they're in retirement and they spend that money down, that will force our hand to rebalance the portfolio. But if you have enough of that dry powder, you can be patient and let the market tell you how to rebalance. And I think what the market might be telling us today is valuations are elevated. I'm a long-term optimist, but I know that considering where we were in April, what's wrong with taking profits when certain stock indices have, higher single digit returns? I think it's a reasonable time to consider that. So it's not an all or nothing trade. If there was anything I would drive home, this is not about getting out of stocks, like you said. But again, what is wrong with taking 4 or 5% off the table, allocating it to an asset that might have underperformed? And then when the market does hit that air bubble, because we have a couple of those air bubbles every year, you can go back and rebuy the same stuff you just bought if you want to be tactical. But you only get one shot at retirement. And if you don't take the chance to take those profits, I think April was a good reminder that nothing ever moves in a straight line. So spend the time not just on how to allocate your portfolio between stocks, bonds, and other investments. Spend the time on figuring out where is the money going to come from, what specific investments in my portfolio. And that, I think, will lend itself to a lot more clarity and peace of mind for folks that are on the cusp of retirement today.
Absolutely. We want you not to survive retirement. We want you to thrive in retirement. And that means you need a dedicated plan with a dedicated set of processes to help you with your ADRs. That's your allocation, your diversification, your rebalancing protocol, and your security selection. So let's find that pathway to yes, which is a pathway to success. And that comes from the art of the rebalance today. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. David, it's so critical that people solve and eliminate this sequence for return risk. How specifically does VestGen Wealth Partners use what you were just talking about to solve for the conundrum that too many people with 401ks and target date funds fall into, which is sequence of return risk?
Right. I mean, when we talk sequence of return risk, what we mean is you retire into a bear market, a down market, and now you are forced to sell risk assets at low or depressed prices. And no one wants to sell their tech stocks when they're 20% off their highs. But the only way you make sure that you don't sell those assets at depressed prices is to have some of that safe money set aside beforehand. And if you compare that to like the way 401ks work or target date funds work, unfortunately, those sales happen pro rata, meaning you don't get to cherry pick. So while I think those might be useful tools for a lot of folks as they accumulate dollars for retirement, I would argue that in that distribution phase, once you start taking distributions, I'm not sure that's the best tool for everybody out there. Likewise, this is a good reminder, I think, for folks that cash is an asset class. And if you don't have cash going into retirement, it's really hard to build up cash. So I was with a family the other day, and this might sound counter to what you think of when we think of financial planning and financial advisors, but we had decided that they had plenty of money in their 401ks, but what they didn't have enough was of just good old-fashioned cash in the bank. So we're now diverting what would be 401k contributions to build up these cash reserves just so they have peace of mind and they have emergency money and they can help out their family. And the coolest thing about it is it will also let us be a little bit more aggressive with their other investments. And that's the key, is to have tax diversification on top of your retirement account diversification.
833-964-PLAN, 833-964-PLAN, getretiredstayretired.com. When you connect with us online, request a complimentary strategy session today. When you connect with us online, download our OVA guide, One Big Beautiful Bill Act, so you as an investor can know how to position to take advantage of the changes in the tax code. You're listening to In the Know, Craig Bolanos and David Bolanos, VestGen Wealth Partners, AM 560, The Answer.
Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560, The Answer.
Listen, we talked about a lot of great content. We talked about the soft landing. We talked about the GDP. We talked about the current state of the economy. We didn't address the bifurcation between capitalization, large caps doing good, mid caps, small caps on the struggle bus, but that's all a byproduct of trade, currency, tariffs, and other things that are here. But we also spent some time financially nerding out. And I think it's really important that you work with advisors that have a very strong technical background in markets and have traders who have worked on the floor of the exchange, in addition to that technical competency that needs to extend into the world of taxes, everything that's the one big beautiful bill, and financial planning that is rooted in goals-based and cash flow modeling. And what we welcome you to experience is this VestGen difference. It's a multifamily office because, David, most people have a advisor experience that looks like what compared to the VestGen experience that looks like this?
I would venture to say most folks have a compartmentalized experience where they have an insurance person, an estate planning attorney, a CPA, an investment person. And the question is when do those people ever talk to each other? And how often is it that you, the client, is always the one making the phone calls and no one can do anything behind the scenes? The difference for us is we have everybody under one roof. Do we need to be your CPA? No, but we do taxes here. So we can flip the 1040 upside down and walk you through the lines that are actually important to you. Do we need to be your estate planning attorney? No, but I can tell you there's a benefit when we can integrate the estate plan with your resources because we know what your value system is. Because there's a difference between giving money to people and putting people in a position to be successful with that gift. So if you want the holistic experience, that is the difference that we provide. And we do it in a very open, honest, and an opinionated way. And I think that's one of the things lacking today is no one wants to give an opinion. That's what we provide here, and we do it well.
Thank you. And those opinions, they are TNT. That means they're tested in the trenches. It's everything we do is a systematic, repeatable process that is data-driven, not sentiment-driven, and that's what you need if you too want to get retired and stay retired. So connect with us online, getretiredstayretired.com. That's getretiredstayretired.com.